All right, good morning, everybody. So we are getting more inflation data today. Some of it from Walmart and its reporting. That actually is going to have more impact than some of the econ that we're going to get today. Walmart's reporting and what they have to say after the report is going to be really telling. The other one was the numbers coming out. This would help if I sign into Thinkorswim. Been using TradingView all morning, working on these bots. Bots are driving me crazy. Right, so the other one was Home Depot. They hit their target, but how they hit it was contested a little bit. Their sales volume wasn't higher. It was they charged more for what they sold, so they hit their target goal. So they're passing that inflation on through the products that they sell, and that's not sustainable. And it shows a decrease in sales. And so even though their numbers hit, they're down this morning. So between Walmart and Home Depot, we're getting a little bit more about a little bit more of a clearer picture about inflation. Some would argue a better picture on inflation than, antiquated government look back systems like PPI and CPI. So, be really interested to hear what Walmart has to say this morning. This is a part of that discussion where, when we talk about putting together a morning routine or having your own little morning system in place, keeping track of who has earnings isn't necessarily so that you can play the earnings trade. It's understanding that whoever's going to report earnings has the ability or the capacity to really rock the market. Walmart by itself, in market cap isn't enough to rock this market, but they can certainly come out chipping their teeth and say things that cause concern or market sentiment to change. So when you're working on building your own morning briefing, there's really no place to learn that one, right? Which names out there are big enough or have a history of rocking the market? You kind of got to get a feel for it. You can see on the agenda today, we've got a lot of Fed speakers, mostly still talking from the same page, right? They're all just trying to get that message out. Higher for longer is the message. Kicking the can down the road, bringing the whole curve up with it. We've seen some pretty interesting moves in the later part of the day yesterday, and they didn't come from the dollar, and it didn't come from US dollar Japan, which is kind of interesting. It's been a while since we've had a move in the S&P that did not come from the dollar and from US dollar Japan. So we decoupled and we broke that link. Yeah. We do have an additional auction today at 11 o'clock. And that's it for the day on the econ side of things, other than speakers, right? So you should be pretty good to go on your 0-day plays. And like we've been talking about, when it comes to options, they are a work in progress. The market makers and the CBOE continue to work together to try new and different and experimental things. And one of those experiments was bringing in 3 expirations a week. And they had that in the S&P for almost a decade. And they monitored and observed how that affected and changed the market. And after a decade, they spread it out to the Qs and IWM, but then they also stepped up the game and brought in 5 expirations a week in the SPX. Starting this week, they've now spread that out into SPY, the Qs. So you can now get a 0-day every single day of the week in the indexes, even if you don't want to trade the big one like the SPX. Now, an argument to be made on this, if you're day trading, getting filled is the struggle, right? Obviously, when you're using SPY, the bid ask is so tight that you can just market order in. Now, I'm a person who usually stomps their foot and says, don't market order into things. This slippage is going to eat you up. It's not worth it. You're going to start out in the hole. And I'll carry that argument everywhere I go, except SPY. The slippage, generally speaking, is 1 penny, maybe 2 pennies. I don't like it, but I want filled. No doubt, no hesitation, no questions. Give me my damn trade. And I can do that in SPY just by hitting market order every single time. Getting in, getting out. And I slip maybe 2 or 3 pennies in normal market conditions at the worst. If you're trading in the SPX and you hit market order, you're going to slip $80, $90, $120. It's nasty. It's costly. It hurts. You start out in the hole. You really never want to market order into that thing. And really, you don't want to market order out, but I mean, it moves so fast. Sometimes you have to. So you can increase your volume size and trade 20, 30, 40 SPY options to size up and make it as big or comparably as big as the SPX and not have to worry about the slippage as bad as in the SPX. All you got to worry about is commissions. Well, depending on the broker you use, you either don't have commissions at all, or your commissions cap out at, say, 10 contracts. So it won't matter if you do 10 SPY calls or 100 SPY calls, your commissions would stop at 10. It's worth considering the fact that SPY, as a day trading product, often will offer you better opportunities than the SPX. Now, the SPX, I mean, that sucker moves. You know, you make $100 a minute with 1 contract in that thing on a good day. And it's just, the money is fast and that thing moves. But it's getting in and out that's such a struggle with that thing. If you use limit orders to reduce that slippage, then you struggle with missing the trade completely, or, you know, getting wicked out, stopped out, filled at the wrong time. It's just difficult, but not with SPY. And now SPY has 0-day expirations 5 days a week, just like the SPX does. So something to consider. All right, not much of a surprise that we had a down day yesterday, right? We were talking about how overextended we were, overbought. I hate the word, but you know, we're overbought. So it's not a surprise that the market paused and has stalled a little bit. And we now have 3 days in a row, or at least we're starting our third day, IX10. So one day is an inside day, multiple days become an IX10. It's like an inside day collection. The longer we stay inside day, the more energy we're building up. And when the move finally comes, it's usually a big one. Now, there's no promise about what direction the move is going to come. It's just a direction, or just a promise that a big move is likely. When we're talking about an inside day, if the day that we're inside of is a really, really big day, then that's kind of worthless. It's not much of a surprise if you set like a 4% candle that you spend a week inside of that 4% candle, because it's a big, massive candle. Those are worthless inside days. We don't care about those. They have no value. But when your inside day is a very narrow day, and then the next one is also, and then the next one is also, that builds a lot of compression. And it also starts building up a lot of open interest in this area and in this area. And the longer we stay there, the more that open interest builds and builds and builds. And when we break through, one side's going to get squeezed. The shorts are going to get squeezed, or the longs are going to get squeezed. It's not an if, it's just when. Now, there's always been an argument about wicking out, leaving the range and then coming back in. I really don't harbor too much on that, right? You can. As with anything in trading, choices have consequences. If you decide that it broke out of the box, even momentarily, and came back in, and that negates the inside day at that point, fine, do that. But what I've learned is that a little wick out doesn't take away from the overall trade, or the overall strategy, or the overall analysis. We are right at the 38.2 retrace line. I keep that Fibonacci level really light so we can see it. My mouse, it gets near the indicator, it kind of lights up a little bit, but otherwise it stays really shaded, kind of dark, because I don't want it in my face all the time. The retrace is from the first of the year until now. So from the highest point in 2022 down to the lowest point in 2022. And if you were to hand draw your Fibonacci instead of using an indicator, the level that you see might be a 786. Nope, it would be a 618 or something comparable to that, right? The indicator doesn't care. It'll draw it like upside down, use the wrong numbers, but it's still a level there either way. In old school technical analysis, when it comes to reading fib, they say as long as the market doesn't close through the other side of the 618, then your original trend is still intact. Now, I've always been a person to argue that logic in today's world. Back in the 80s, when people were spending thousands of dollars for data and they had to pool all their resources to get delayed data of an hour or more, 618 made sense. Sure, it made perfect sense. They just didn't have the data. Welcome to the new world. The marketplace records data at hundreds and millions of billions of a second. It's massive. The amount of data transfer we can do, and the amount of information that can be transmitted is just phenomenal. So it doesn't make sense to wait for a market to get all the way up to that 618 level before we decide that a trend has changed, right? So I threw that old school book out the window and I made a new set of rules that said 786 makes more sense. And I've been using that ever since. So to me, the 618 doesn't have any weight to it. I don't care. The market does, but I don't care. The reason I bring it up is because we're at that level. And should we close above it on the week, then that would be considered a change from this downtrend that we've been in, right? If it's just a downtrend, it shouldn't pull back higher than that before continuing lower. If the downtrend is done, then this pullback coming higher than the 618 would indicate that that trend is dead. Now, the thing about a trend and it dying is it can restart again. It's all about analysis and what your statement is. So let's get this out of the way for a moment. When you've got a trending market, we're always asking that question about the pullback. And as long as the pullback doesn't go too far, then we've still got a trend. But as soon as that pullback goes back too far, the trend is done. And that's what we're discussing right now, the 618. If we pull back too far and we close on the other side of the 618, then we would say that that downtrend is done. It's dead. It's over. But that doesn't imply that we're going to go up. There's no promise made that we're going to go up or that the market is going to begin trending in the upward direction. Nothing like that. The statement only says that the downtrend is done. It's dead. And even a trend that is dead could start basing and then break down and begin a new trend in the same direction without ever having changed directions at all. So when we make that statement that this current downtrend is dead, that's all the statement is that it's dead. There's no implied promise of an uptrend or a change in direction. Okay, so it is important to make that distinction. We have yet again kind of light volume, nothing extreme, which is fine. It's kind of the sweet spot. It's not too heavy and it's not too light, and there's nothing really shocking about that. We got inflation data on deck, and people want to hear, what the inflation numbers are. That's all we need to see out of that indicator. So we generally just turn it off at that point. It takes up a lot of space. And once we get our perspective from it, we don't need it on there anymore. So we can see the range since Friday. It is the one still in play. That reversal yesterday is what I was talking about when I said that this reversal wasn't shown in the dollar and in the DIX or in the US dollar Japan, which was kind of interesting. I put it out on Twitter when it just started to roll over. I actually took a SPX position when it first started to roll over. The only thing we had as a solid signal was that rising wedge breaking out. Rising wedges generally break to the downside. And sometimes they give you that fake breakout first. They'll do that one last hurrah up, and then they'll dump, kind of faking everybody out, trapping in the new traders, and then rolling over on them and crushing all their hopes. So after the last breakup and it started to come back down, that's where I took the picture, sent it out to Twitter, and pointed out this was basically all we had was that. If you look at where it lines up on finance, I had already made the comment multiple times yesterday that we just didn't have finance in the game. It wasn't playing, but that white line here is VWAP. So it was under VWAP and testing the lows, or was near the lows, but we hadn't yet broke down. It was around 230 or so. And the idea was watch out at 3 o'clock, dollar close, bonds close, and we could see this market finally flip over and start moving back down again. The grind all day yesterday was just off. It wasn't The grind wasn't strong enough to give us good bullish signals to go long. This is the weighted AD. If we wanted to go long with strong bullish signals, it needs to be above 500. We never got above 500 yesterday, so we never had a good solid reason to go long. And yet there was some good moves to the upside yesterday. We had that nice expansion off the double bottom, and this thing never expanded and offered us that opportunity. I think that's the wrong dayless. Right there. So nice expansion on that double bottom, but no bullish trigger. So we're looking for a reason to go short, and the only thing we had is that rising wedge breakout to the downside. We would need to see the weighted AD get below 0 first, and for a good solid long-term trade to the downside, we would need to be below 500. But we had the 0 line cross, and we had the ticks drop down minus 750, 850 into 1,000. Those are good solid bearish signals, bearish triggers at least. And everything kind of followed suit and away we went. But what we didn't have is the dollar and US dollar Japan giving good, strong, solid breakout signals, which would have helped confirm everything rolling over and dumping to the downside. This area right here is when the S&P started to roll over and dump, and we went into the close. And nothing there is what we would expect to see. And then the same thing for the dollar. Sure, it migrated up, kind of grind a little bit, but nothing like we say have this morning. Not a big move. So the value of watching the dollar and US dollar Japan, and it has been valuable. It's been awesome. It's losing its value. And we knew it would sooner or later, but just pointing it out that it's coming sooner rather than later. So it's not that we're going to quit watching these metrics now, but they're going to hold less value in our analysis on a day-to-day basis. Yeah, a lot less. This big move here in US dollar Japan and the Dixie matches up with this very small breakout move here in the S&P. That's all we got out of that. Yeah. Okie dokie. All right. So in this IX10 situation, we've discussed the idea that the longer we stay range bound here, the more we're building up on each side this wall of orders or this wall of contracts. And that's going to be a part of the reason why when we do finally break out, that the breakout is very likely to be violent and big. It's because one side or the other is going to get squeezed. We don't have a market maker move this morning. We only have our regular ADR. The current 21-day ADR is 2.3%. It's around $94. So from the close yesterday, which was a red day, we now have a red to green in an uptrend in an IX10. We're above the weekly pivot. So a topside breakout here could really easily get us into 40.75 and 4100 today. I know that might sound extreme, but due to the squeeze potential of the orders on each side of this and which side is going to get squeezed. Add that with the inflation data today. The move could be a pretty good size move all the way up to 4,100. That would expand beyond our ADR. The top side ADR is 4070. The bottom ADR is 3880. The mid-level ADR 4025 and 3925. Just a little rounding there to kind of give us some flat numbers. We're above the daily pivot, but we've already hit it, so no MDP, and we're above the weekly pivot. And if we break out to the upside, there is nothing overhead to worry about. There's actually a gravity point up there because there is a gap to fill. Now, because the ES is open, 22 hours a day, the gap doesn't show up on the daily chart the way it would on, say, something like the SPX. So for that discussion, it's really just easier to use the SPX. 4037 is the bottom of the gap. And 4011, the cog line, is the top of the gap. And then depending on how you use gaps in your analysis and measurement, there is a pivot at 4083, which would be the open of the day that we got the gap started. I know that kind of just sounds, I don't have a better way to say it. So we opened there, we closed there, and then the gap happened and we opened up way down here. For us to close the gap, we have to get through this, which I call a channel bottom, just so that my labels work and kind of distinguish what I'm looking at. We have to get through that spot. Then we have to get all the way up to where the market closed that day, because that's how I read gaps. But other market analysts will say, you just need to get back to the day that the gap started. So as their target would be, as long as we can get to that candle, the gap would be closed. I'm not here to argue the merits of one versus the other. Choose one and just be consistent in your choice from now on. Doesn't matter which one you choose. Me, I choose the close, not just any part of the candle. Those will become gravity points as we get closer to them. First, getting through that level though, 4037. Once we get inside of that channel, that will become our support for the foreseeable future. And we'll begin working our way up through the rest of these pivot points. Now, we talked about the good side. If the market likes what it hears today, and we really, I say we, but the market should have done a better job kind of preparing everybody for last week's CPI numbers. We've been in this state of affairs where good is bad and bad is good. But when it comes to the CPI numbers, that wasn't exactly the case. If the CPI numbers showed that inflation was abating, that was not going to make the market go down. Good news would not make the market go down in that situation, because that's what the Fed has been trying to do, right? Is shut down inflation. So when we talk about good and bad and we say, oh, the job numbers were really good. Oh, there goes the market and down we go. Good is bad. Because good job numbers is not what the Fed wants to see. CPI being good, that's exactly what the Fed is trying to accomplish. So good is good. And if it was bad, that would have been good too. It was either way, CPI was going to make us go up. And so everybody who went short right before CPI hit and is now getting just gutted, a lot more people should have been getting that message out. We're kind of in the same situation today. We're getting more inflation numbers and inflation points of view, right, from the earnings with Home Depot and Walmart. If they come out and say that inflation is really kicking their butt on the Walmart side and is really harming them, and then they forward project from that and they give out some crazy numbers, that would be bad news. The market's not going to like that bad news, because it's going to bring the Fed back in with a discussion of 75 basis point rate hike instead of the 50 basis points that they've been talking about for December. And we're very likely going to go down from here. So today, bad numbers are going to be bad for the market. And really not just today, it's this week, right? We've got multiple inflation data points coming in this week. Wednesday, production and retail sales. So a discussion for the downside move. We need to get through the daily pivot point. Then we need to get through the cash open of yesterday, which would be 39.81-ish. Then the Globex open from last night, our own Globex low, 39.71, and then yesterday's low, 39.64. One low that I didn't mention that you could add is 39.77, and that would be the low of yesterday's Globex. You could also add the high of yesterday's Globex, and that one, that's a good one to add, 39.96. It kind of bridges the divide from where we're at currently down to that daily pivot point. The low of yesterday lines up kind of close, and we're talking about the Globex low. I need to be specific with that. It kind of lines up close to where we closed and or where the Globex open was. So a lot of tangled up pivots on that lower end, but the Globex high, 39.96, that's a really good pivot. I would highly recommend you add that pivot today. We have the previous week's high overhead at 4,009. So I'd add that to your analysis if you don't yet have it. And you can see that we're struggling with a pivot point this morning of the moving average. It's a 4-period daily moving average. When we're above the 4-period, we're bullish. When we're below it, we're bearish. When we're crossing through it, we're transitioning from bullish to bearish or vice versa. You can see for multiple days now, we've been riding above that 4-period moving average, kind of got a bit overextended as we went from Thursday into Friday and then Monday, right? And the 4-period caught up with us. Now it's going to be, what are we going to do with it? Are we going to break down below it or not? The rest of the moving averages are all the way down here. There's really nothing. 10, 20, 50, they're all a long ways off. Not very helpful. The 200 is still quite a bit over our head. That's the 200 SMA. And there's the 200 EMA. You can see it's a lot closer than that SMA, 40.28. A topside breakout today, and we're going to hit the 200 EMA. And that very likely is going to be a first touch rejection play. I don't know how far the short will go, but I'm going to be ready to short that sucker the first time we hit it. 5 points, 7 points. You know, I'm not saying we're going to just dump like we did back in August. I'm not saying that, but the first time we hit it, we're very likely going to reject off of it. So first touch, you can do that in the SPX, you know, go down the list. I'm sure a lot of them are getting ready to hit that 200 period moving average. If you don't have the ability to bring that 200 period moving average onto your intraday chart, there's a real simple solution to that. Don't stress on it. Just go out to the daily chart, mark where that thing is with a drawing tool. You got the bubble right there. It says 4028.7. Mark it. And then go back into your smaller time frame. Your line is going to be there. That 200 period daily moving average is only going to update once a day. Once it's there, it's there. It might, depending on your broker, it might shift a little bit, like a couple ticks. So go out and glance at it once in a while. Make sure it hasn't moved. Otherwise, the line that you draw will be more than enough. All right. So don't stress about your broker not having some ability to show higher time frame moving averages on a lower time frame chart. It's fine. It's no big deal. So 39.89 is where that 4 period moving average is. We'll be looking for a definitive cross of that 4 period to the downside. Ten-day, 30-minute volume profile. We're at the top of the box. And when we're at the top, we have every expectation that we're going to go to the bottom of the box. When we're at the bottom, we expect to go to the top of the box. If we break below 4,000, we start to get into an air pocket of risk today. You can see that this volume right in here is the last hurrah. And should we break through that level, especially say the low of yesterday, then we're getting into this really shallow area of volume, called an air pocket. Price generally moves through air pockets really fast because there's not a lot there to slow it down. It's kind of like falling out of a tree and there's not a lot of branches to hit on the way down. So a little bit of concern if we do turn negative and start to dump. 38.50 is so easy to hit today. 38.50 would be below the current point of control. And the idea is if we can get through 39.20, we're going to get to that point of control. So below 39.20, we're going to 39.80. There is a cog line at 39.11. And then there's the roundy, which generally, you know, has a little bit of psychological value, but 38.70 is that point of control. We do have a VPOC at 39.13. It's really close to the cog line at 39.11. Just one more data point that says if we do fall to the downside, we're very likely going to have at least one touch play at the 39.11, 39.12, 39.13, right around in there. We're basically talking about moving back through this zone. If we break down today below that 39.60 level. I talked about it last week. and I'll mention it again this morning. Measuring big candles is a really good way to add some perspective and some analysis. And if you measure Friday's really big candle, you can see that we've got that 50% mark at 38.62. Be the midpoint. If we're going to continue to be bullish, markets don't move straight up. We expect to see some form of a pullback. That pullback, though, should not breach and close below 38.62. So we could go down today, down to 38.70s, and it would still be fine in that vein or in that context that says it's okay. Markets need to pull back, and we would still be bullish. The concern is that it's below 39.25, which is this pivot point back here. And in technical analysis, once you've reached through that zone and you've closed above it, you really don't want to see the market come back down below it. Right. And if you're trying to visualize why that is, think about a market making a move to the upside in a trend. Each one of these pullbacks shouldn't go too far, right? A pullback should only pull back a little ways. So if it pulls back lower than that, if it pulls back lower than that right there, it kind of calls into question that trend that you're in. Right? I mean, that makes sense. So we shouldn't go below 39.26. We shouldn't close below that on the week, not the day, but on the week. So we could go down there today, tomorrow, as long as at the end of the week, we close above that level, we're fine. On a day-to-day basis, we need to hold above 38.62. If we close below that on a daily basis, it calls into question the current trend that we're in. Now you've got a little more context on how far back we could pull back before that pullback is considered too far. And again, we can kill a trend or we can call a trend dead. And then that trend could start again, even in the same direction. It does not imply that we're going to go down just because the uptrend is dead. It just means the uptrend is dead. If you're wondering where I learned that sort of stuff, there's a really old book written by Grimes that talks about this stuff. It was a great book. I shared the book in the Bullish Bears Discord as a PDF document. I found it on Google. I just went out to Google and searched for Grimes. The title of the book is The Art and Science of Technical Analysis. It's an old book. I'm sure there's much more modern books, but it was free. Didn't cost me anything to get it. And, I like free. A little tip when it comes to working on something like that is if you make a Discord, they're free. Doesn't cost you anything to make a Discord. You can go in and take a book like what Grimes wrote and break it all down into notes and analysis and build strategies. Kind of looks familiar, doesn't it? We were just talking about that. So you can use Discord for your learning center. Find a book that you like, or say a video that you like, throw it into a Discord and rip it apart and analyze it, write your notes and build game theory and all of that. Still got moves to the upside in Bitcoin. We still have KWEB, so the China state banks are still buying, which means we should continue to see the China ADR names making moves to the upside. Alibaba, Baidu, JD, PDD, all of those. We don't know when that buying is going to stop. We know it will, right, eventually, but I don't think there's been a single publication that really referenced how much each bank has to buy, or I don't know. But right now, the flow coming into these is like standing in a river with this constant buy pressure on the market. And that helps, right? I mean, a lot. By itself, it's not going to be enough to turn these names around and get them, back up to 2022 highs. That's not on the table. But we could get some form of trendline breakover and, kind of work our way up. And I'm looking at BABA, but, a lot of them have the same setup. So we're just starting to get that bear flag wedge or that bear pennant. A bear pennant failure or a bear flag failure would be a topside breakout and a TRB. And we call it failure because it's supposed to, a regular flag or a regular pennant should break to the downside. It's what they're designed to do. So when they don't do what they're supposed to do, we call them failure. And it's a really great trade strategy. It's one of the first ones that I ever built for myself, was a bear flag failure or a bear pennant failure. You see that gap is closed on Baidu. That's a weekly gap. Got to be a little concerned about gap closes, since a lot of times getting that gap closed was the whole purpose of the move. So here in Baidu, for an example, we've made that move. Now I got to kind of be concerned that that might be the end of the move. But that's on the daily chart. And when we get into the intraday, we can see that we're still moving. And we're getting kind of close to the roundy, which makes that the new magnet. So $100 in Baidu. Bring it out to the daily again. And it's this gap channel. All right, so we closed here at 104.41 and we opened the next day at $99 and we continued to fall. That left a gap that needs to be resolved, needs to be filled. The bottom of the gap, I just label it a channel bottom, or if we're going the other direction, it'd be the channel top. And that's at $99. We're underneath that still, we're at 97-ish, depending on the bid ask this morning. So that's going to be your first level of resistance, is to get to 99, get through it, close on the other side of it, and then target 104.41. Same thing with BABA. So we've got a gap. We closed at 76.31. We opened the next day at 73.50. This morning we're at 78.80. So we are above all of that. We're sitting up here, which means we'll be focusing on these gaps now instead of the ones that I just drew out. But any move to the downside, any sort of fade back, will put 76.31 and then 73.28 into play. So right now, $80 or 79.77 is going to be your target. If you can get through that, 81.24 will close that gap. So 79.77 is your channel bottom. And then 81.24 is the gap close. So for the whole KWEB group, this is all going to be based on that China ADR, the China push, all of that. Going to continue to want to watch for any news that talks about that, anything that comes out. If they did make an announcement that they had ordered the banks to do the buying, it's very likely there's going to be another announcement when that is done. Now, I don't know for sure, but that would be the anticipation, right? I don't know where that news will go, but it'll end up everywhere by the time it's done. So it's not like you got to get some paid news service. Once the word starts getting out, it'll just go and it'll spread everywhere. So anything from the China state banks not buying anymore, that'd be something you really want to pay attention to. And then things like EEM and KWEB. If either of those start to get weak or begin heading to the downside, they are a perfect representation right now of those China ADRs. So any weakness or any sort of downward move in KWEB or EEM is going to be a warning to you if you're in any of those China ADR names that the flow is drying up or that it's starting to slow down or stall or pause or stop. And the reason that these markets, KWEB and EEM, are so gappy is because they are emerging markets. They're traded more when we're asleep because they're traded by nations around the world more than they are traded by us. Or the names that are in it, right? Say it that way. All right, retail 1.7%. That's up this morning. We can always look inside the retail basket or any of these ETFs and see the names that are in there that make it up. Staples, construction, technology, biotech. Just about every single sector is up this morning, at least 0.5% that we would generally focus on. So we want to kind of turn that around. Since nearly everything is up, we want to focus on what's not up. It's often a smaller list in a situation like this. So natural gas is down 1%. The 10-year, the dollar, not much of a surprise. Solar is down. Retail banking is flat. So I need to back up. Those are not down. Exchange traded solar is flat. Banking is flat. I don't care about flat. I either want 0.5% or more for it to fit, right, if we're going to even bother looking at it. So natural gas being down is the only thing on that list to the downside. There's some that are weak, haven't made the move yet, and that would be energy, airlines, some junk bonds. Otherwise, we're go across the board. So look for a high correlation coefficient today. I know it's really big, fancy language. Just go to Market Watch, drop down to visualize, change your heat map to the index, pick your index. This is the S&P 100. It has 101 names to it and a high correlation coefficient. All 99, 100, or 101 names will be moving in the same direction. It means on a day like this, you don't have to bother being a stock picker, right? You don't have to go in and like deep dive, evaluate which one you're going to day trade. In a high correlation coefficient, everything's moving in the same direction. This is where we came up with the alpha protocols. So you could watch the S&P 100. These are detachable. So you could also watch, you know, the NASDAQ 100, the S&P 100. You could build this thing up, watch a bunch of indexes all at once. We're looking for a high correlation coefficient, but I got to stress caution. When the market gets that tightly correlated, it can make some very extreme moves, and it doesn't have to be down either. We can crash up just as easily as we crash down. So I'll stress caution, be very careful. Econ's hitting here. It's 8:30. Data should be coming out literally right now. Everybody be safe. Have a good day. I will see you all tomorrow.